Welcome to last month, this month, for August and September. Let's jump right in and start taking a look at the markets. If we take a look at what happened in August, we saw really strong returns in the stock market indices, really uncharacteristic for the month of August. Month of August tends to be a weaker month, but here we had the S&P 500 producing a return of over 7%. We had the NASDAQ just under 10%, and we've seen this really narrowing of stocks in the major indices, driving these indices higher. But nevertheless, these are strong numbers for sure, especially in a typical weaker time of the year for the stock market. The laggard was the TSX Composite Index, coming in at just over 2%. If we take a look at the major sectors of the market, the big three that have been driving the market higher for the work from home have been the consumer discretionary, the communication services, and also the technology sector as well. Once again, they outperformed in the month of August. We did see the industrial sector actually perform very well and outperform the S&P 500, which is represented by this red line right here. In the month of August, what we saw investors actually rotating some days into the industrial sector and other days not, but overall, we did see the industrial sector outperform as investors are starting to build on the economic recovery theme. The materials sector actually underperformed by quite a bit relative to the industrial sector. Usually those two pair together. It's going to be interesting to see exactly how these two sectors play out over the next few months. Typically, we'd like to see the material sector perform well at the same time as the industrial sector, really to confirm the economic growth story. The last month in August, we did see the staples, healthcare, and utility sector all underperform the S&P 500. So the defensive sectors were not favored. Real estate was slightly negative as well. If we take a look at selected subsectors of the market, we saw the silver sector, silver bullion, do extremely well, returned over 15% in the month of August. It became a really hot commodity. Investors looked at the silver and said, wow, this is a really cheap commodity relative to the price of gold. And they poured into the sector. It became the story of the day, and a lot of retail investors poured into silver bullion. Interesting that gold was actually nominally down for the month at the same time that silver was up. So silver was also driven partly because the base metals were higher, and silver does have base metal properties as well. If we take a look here, the transportation sector outperformed the S&P 500, which is represented by this red line, the retail sector as well. This was really driven by, once again, the economic development theme that's taking place. Biotech has produced a return of just under 1%. It's been lagging the market recently. We saw in July it lagged the market. It typically doesn't. It typically has a strong month in the month of July. And when a sector underperforms, when it typically does well in a certain month, it can often indicate this further weakness ahead. And that's exactly what's taken place for the biotech sector. And this is an election year, so very often the biotech sector and the healthcare sector can lag a little bit if investors are a little bit concerned about those sectors being a political football. We've seen a little bit of dying down about the whole excitement about vaccines affecting those two sectors as well. If we take a look at what's coming up for selected economic reports and also earnings in the month of September, if we start by taking a look at the economic reports, the big one is the non-farm payrolls expected to come out on September the 4th. On Friday at 1.49 million. Really what you want to do is you want to take a look at the expected, how investors react to the payroll number. If we see the investors actually drive the stock market higher based upon the payroll number coming into next week, that would actually be a positive sign. Very often we will see the stock market coming out off a holiday can have an inflection point. So we really want to see some really strong carry through, next week if we do see a strong payroll numbers come out. Also, too, in next Thursday and Friday, the 10th and the 11th, we see the inflation numbers start to come out. The big one that we're going to be looking at is the core inflation number expected to come at 1.6% or 1.5%, well below the targeted rate of inflation, which has previously been 2%. Now, I know recently the Federal Reserve came out and said they were using an average inflation target, which means they can let inflation run hot. But right now, inflation is well under its previous target of 2%. So it doesn't really have an impact. The Federal Reserve was laying more of the groundwork for any future inflation rises that may take place. Also, too, if we go back and take a look on Wednesday, we can see that we have the Federal Reserve Beige Book come out. We can see what happened in the last minutes, perhaps a little bit of disagreement between the different governors as well. It gives a little bit more color to what's taking place. On the 16th, we see the Federal Reserve actually come up with their announcement as far as the interest rate goes. Nothing expected there, but we are looking really at more or less the guidance taking place. As far as earnings go, we're really tailing off into the earnings season. Some of the big companies reporting would be Oracle on the 9th. Oracle has really been underperforming for a technology company, even though it announced that it's placing a bid for TikTok in August. It really has been an underperforming sector relative to the S&P 500. Kroger comes out on the 11th. We get a little bit of a view into Kroger there. 15th, we see Adobe and FedEx. FedEx can be interesting because we can take a look at what their guidance might be on the work from home. If we're still seeing a whole bunch of purchases taking place, what their expectations are as far as purchases and deliveries as well. General Mills on the 16th. General Mills, obviously a consumer staples company. Now, consumer staples companies tend to do well in October, so it'll be interesting to see their guidance. On the 22nd, we have Tesla, their AGM. Tesla's been a hot stock, obviously. It's done really well. Nothing on substantial news, but it's done really well because investors have been pouring into the Tesla stock itself. So a lot of anticipation for this, the AGM coming up on the 22nd. Costco on the 24th, just starting its seasonal period shortly as well. So that should give an indication for Costco as it starts the seasonal period. Also, it's going to be interesting to see the Carnival on the 29th because everybody's expecting the travel industry to really be slowing down. Well, it's slowed down substantially, but to remain subdued. But Carnival's already started to open up its cruises in Europe. It's going to be interesting to see what their feedback has been as far as that goes. And a lot of investors are starting to creep into that particular the travel industry itself. So that will be interesting as well. I wanted to put up this chart for the technicals for the S&P 500. This is being passed around on the internet quite a bit. We can see here that we have seen this strong trend line really since 2009, going up all the way up here. Obviously some variations along the way. But what we're seeing here is this megaphone pattern. So we're seeing higher highs and lower lows taking place. And we're seeing this megaphone take shape right here. Now, this is typically a distribution pattern at the top of a market. It doesn't mean the market's about to roll over. The S&P 500 could go to 4,000. It could break above this and then pull back. But all it's saying is that this is often a distribution pattern at the top of a market. So we might see a little bit of softness ahead, especially if we start to turn back at these levels here. If we take a look at the average sector trends since 1990 for the major sectors, it's the defensive sectors that tend to lead the way in the month of September. Also, the telecom sector tends to be the top sector. This is the average gain for the sector itself in the telecom sector, and this chart's ranked by the average gain here all the way down. And you can see the telecom tends to do very well because it tends to be a little bit of a defensive sector in the sense of its high dividends. Also, too, as well, it's a hardware release cycle that takes place at this time of year for a lot of the telecom companies. That helps to provide a little bit of excitement in that sector. This last column tells you the frequency of outperformance since 1990 to 2018 of the sector and the sectors relative to the S&P 500. You can see the telecom sectors actually outperformed the S&P 500 62% of the time. If we jump right down to the bottom of the chart, the materials sector tends to be the weakest sector, a major sector of the market, and coming in with an average loss of 2% since 1990 to 2018, and only outperforming the S&P 500 24% of the time. It doesn't mean it can't outperform the S&P 500 this time, but it's been one of the weaker sectors overall. If we jump to the selected subsectors, you can see gold tends to do well here, but you got to be careful because gold finishes up its seasonal period in early October and can sometimes finish in late September as well. So you have to be a little bit careful with that one. And we're starting to see a little bit of weakness in gold right here, right now. The biotech sector finishes its seasonal period in a couple of weeks. It's been underperforming the market right now, so it's really just finishing it up. Silver tends to perform well in the month of September as well. And if we go down to the bottom, close to the bottom here, you can see the chemical sector, just like I made the comment over here for the material sector. And the material sector in the States, about 70% of it is chemical. So you're really getting the chemical component really affecting the material sector here as well. Metals and mining tends to be weaker. Automotive as well. Interesting that the semiconductors, on average, has been a weaker sector. Now, this is actually since 1995 to 2018. But it's produced an average loss of 2.3%. Very often the semiconductors will lead the technology sector. So keep an eye on that sector, because if it starts to roll over, that could have some implications for the technology sector, which has definitely been the leader in the market here. And you can see that semiconductor sector has only outperformed the S&P 500 46% of the time, so almost half the time. But what this is really saying is, with this average loss and not performing well in the month of September, that when the semiconductor sector does not do well, it can really perform poorly in the month of September. I wanted to put up a chart of the VIX, the volatility index, the CBOE volatility index. Now, a lot of graphs are being passed around on the internet about the VIX right now, and I wanted to draw some attention to what's taking place. So let's start by taking a look at the average trend of the VIX. Since 1990 to 2018, on average, this graph represents, every year is different, but on average, you tend to see the VIX actually go down from February, March into late July, and then we start to see an uptick into October as well, where the VIX actually moves higher. And the VIX is really just a fear gauge in the market in a way. So the higher the VIX goes, the more fearful typically investors are in the marketplace. Not always, but it does represent that. And when the VIX is rising, you do see the S&P 500 tends to actually decline here overall. This year, we have seen the VIX actually come down since March, the bottom of the market in March. But the VIX actually gone into about mid-August here and moved lower, and then started to move higher. I'm going to go through that graph right now. So this graph at the top, this top panel is the VIX volatility index, and the S&P 500 is on the bottom. This is a year-to-date graph. If you take a look here, what we did see was the market top in mid-February. You can see here the S&P 500 started to roll over, and the VIX started to move higher. Then the market put the bottom in on March the 23rd, and then started to move higher. But take a look at this. The VIX actually started to pull back before the S&P 500 actually bottomed. So we start to see a little bit of stability in the options market surrounding the future for this volatility before the actual bottom in the stock market. So it is a little bit ahead of what was taking place. So it was a little bit of an indicator. I'll come back to that in a second. Then we saw the S&P 500 obviously move higher all the way into June, and the VIX come all the way down. And you can see here that when the S&P 500 rolled over, the VIX actually went back up, and that's the typical normal circumstance here. Now the S&P 500 paused and then has gone up since then, and the VIX has actually come down. But look what's happened since mid-August. We've seen the VIX actually start to move higher. So what we're seeing here is we're seeing the S&P 500 move higher and the VIX move higher. That doesn't happen very often on a continued basis. Now, there's two things I want to point out with that. The first thing is this actually could be a forewarning of a change, just like what we saw back in March. So the VIX is actually moving before the actual stock market. So typically as the VIX moves higher, typically you would actually see the market rolling over. That hasn't happened, but very often will happen. So it's unusual to see this takes place here. So the fact that we're seeing the VIX go higher and the S&P 500 go higher is not a normal circumstance on average, and often can represent turn of the markets coming up shortly. Something to watch out for overall. I also want to draw your attention to a graph that's also being passed around the internet a lot, and that's the CBOE equity put to call ratio. Now, this is in the options market. It's a contrarian indicator. So when the graph line is up above here, that basically means that there's more puts being written in the market. So the average retail investor is bearish on the market. And when there's more, and when we're down at the bottom end of this graph with going up and down here, that means that more calls are being written. And the retail investors are very bullish on the market. Now, on average, throughout this, in the middle, not including extremes, it's not really that helpful of a ratio. But once you get to a certain point where you're on the extremes, whether it's at the top here or down here on the bottom, that's when you start to get some indications. And when the average retail investor is extremely bullish on the market because they're writing more calls than puts, which is exactly what's taking place here. Here we are, look at this, we're saying some records here for the put-to-call ratio being so low, which means that investors are writing a lot of calls in the market with expectations of the market going up, which is typically a contrarian indicator here. So this is just something to watch out for. And typically, you wait until you start to see this ratio start to rise, meaning that more puts are being written, then that's typically a turning point in the market. We haven't seen that yet, but here we are in extreme, and this often is a contrarian indicator saying that investors are very bullish on the market. The retail investors are very bullish on the market. And when the retail investors are very bullish on the market, they can often be wrong and the market can move into a bearish scenario. I also want to talk about market breadth as well. There's a whole bunch of different ways to measure market breadth. And in this case, I'm going to use a NASDAQ advanced decline line. So this dotted red line is the actual NASDAQ index here, and the black line is the advanced decline line. And what that means is it measures the net of the stocks advancing in the NASDAQ minus the stocks declining. So when this, and what you would expect is as the stock market's rising, you would expect more stocks to be advancing than declining. And that's a typical normal scenario, and you can see that here. Obviously, there's some aberrations that take place here. But what we're seeing recently is we're starting to see this advanced decline line actually coming down. So there's more stocks that are declining than advancing. And what that means is a lot of investors are pouring into the stocks, the FANG stocks, the very popular stocks, but fewer and fewer stocks. It means the stock market becomes more fragile. And that's exactly what we're seeing take place as the NASDAQ is moving higher. So this discrepancy typically doesn't last long. You tend to either see this line will pull up here and start to, you see the market broaden out, or you'll see the stock market go down. But right now, we're seeing a divergence take place. So we could see a little bit of a switch coming up here as well. I wanted to talk about the splitters because we saw some big action in the month of August take place for the two big stocks that split right at the end of the month, actually. So Apple in July announced that they were going to be splitting 4-for-1. And now let's just be clear that all the academic research out there says that if you split a stock, 2-for-1, 3-for-1, 4-for-1, the actual split doesn't do anything for the stock price because you're just taking the equity and dividing it into more components and getting less of it. So if you split a stock price 2-to-1, you're going to get twice as many shares, but the stock price is going to be half the amount. But there's a lot of excitement, a lot of new investors coming into this market as the market's been rallying, and there's been a lot of encouragement taking place for investors to be picking up on all the hype around stock splits. And we saw Apple just perform extremely well, and you can see here this outperformance relative to the S&P 500 that's taken place. And a lot of this actually took place and starting right after it announced that it was going to be splitting. A lot of retail investors started to pour into this into Apple. We also saw that take place with Tesla here. Look at Tesla. Tesla's done unbelievably well. No substantial news, really. I mean, it's met the parameters to be included into the stock market index, but really no substantial news, just like Apple, actually. And we've seen this incredible performance, and the Tesla's actually outperformed the S&P 500 by about 400% since the beginning of the year. An incredible parabolic move that's taken place. And a lot of that, actually, if you take a look here, it was right after the split that had been announced. And there's just all the sense of euphoria that's taking place in the market. But I just want to draw your attention to an analogy for a split. A $5 bill is one bill, but you can divide it into 5 $1 bills, and it's worth exactly the same. So a company, whether its equity is represented by 100 million or a billion or a trillion, in Apple's case, 2 trillion, you can divide that stock in many ways you want, 10-for-1 or 100-for-1. It's still going to be worth 2 trillion in the end. So a $5 bill is worth exactly the same as 5 individual dollar bills. So it's like splitting a $5 bill into 5 individual dollar bills. Now, I want to tell you a little bit of a joke on this one. Credit goes, my hat tip, to Tom McLennan, who's a well-recognized technical analyst. This is his joke. I saw it on Twitter. Basically, the guy walks into a pizza parlor and says, "I'd like to order pizza, please." And the guy behind the counter goes, "How many slices would you like, 8 or 6?" And the guy goes, "I don't think I can eat 8." That's exactly what's happening with the retail investors. They're looking at the stock split and going, "Hey, I get more stock. This is fantastic." It really doesn't make a difference, particularly in today's world, because you don't actually have to buy a whole stock anymore. You can, on a lot of these brokerages, you can actually buy what's actually called, ironically, slices. So you're actually buying a partial stock. So the stock price doesn't matter that much. But we have seen this guy, who I've talked about before, David Portnoy from Barstool Sports. Really good marketer, of course. He's entered into the fray here, and he's leading the Robin Hoodies, this new group of retail investors. And, he's out pounding the market. His rule is stocks never go down. Well, of course they do, but that's what he says. Stocks never go down. And, always buy the split. And so he's been encouraging this price action to take place. And here you can see here that the suits were wrong once again. Always buy the split. And so he's leading a lot of retail investors into this euphoria. And what's happening also as well, it's not just them that's driving up the stocks like Tesla and Apple. The hedge funds are actually taking advantage of this, because once they see what's taking place, they're riding the momentum and saying, well, if we're seeing this shift from a lot of new investors pouring in because the stock's splitting, well, we're going to get in there as well. We're going to play the momentum trade. We'll get out before everybody else gets out, and we'll leave them holding the bag in the end. Interestingly enough, Jim Cramer, September the 1st, announced those who won't split their stocks but still want their stocks to go higher simply don't get it. He's trying to jump on the publicity bandwagon. He's a smart guy. He knows the stock splits actually don't affect the stock price. But with all this euphoria in the market, it has actually developed into this price rise. It's actually being a self-fulfilling prophecy, especially with the hedge funds. Let's talk seasonality. If we look at the month of September, September tends to be the weakest month of the year on average. Now, the one thing I do want to point out, it's really the second half of the month that tends to be weaker. And we tend to see large drops in the market, more so than any other month of the year. September and October tend to be a little bit more volatile. So something to watch out for from a seasonal standpoint. And there's one other thing from a seasonal standpoint we need to watch out for, and that is we are in an election year. So we're in the year 4 here. And this graph shows the performance of the stock market in election year. That's this red line right here. You tend to find that the stock market sort of peaks in August, September, and starts to roll into October. Now, why does that take place? That really comes down to investors being anxious about who's going to get in and what the future of the country is going to be. Now, it's not a Republican or a Democrat thing. It's just that anxiety tends to cause investors to pull back a little bit as far as their appetite for risk. That hasn't happened. We've seen a lot of appetite for risk. We're seeing very high valuations in the market. But we could see this typical pattern what's taken place before as we move closer to the election. And you'll see all sorts of articles being written about, well, Biden will be good for the market or Trump will be good for the market. But it's the anxiety that's actually that causes the uncertainty coming up for the future. And usually what you'll see is you'll actually see the stock market before the election take place start to settle down on average. And this is from 1950 to 2016. And the stock market tends to get a footing once it gets over its anxiousness about what can take place. This gold line here is actually 2016, so this is the last election, if you recall. We did see that top take place in August and September. We saw it roll over, and then coming into October, we saw that stock market actually correct. The bottom was actually in early November, just ahead of the election, and then we saw that rapid run-up take place again. So on average, the stock market tends to be a little bit weaker coming into the election in year 4, and that's where we are now. So we got a double strike against the stock market on a seasonal basis. September tends to be weaker, plus we've also got the election phenomenon. So it's definitely a time for investors to be a little bit cautious in the marketplace. Every month in 2020 has been a crazy month, and I'm sure September will live up to that once again with the unexpected. But thank you very much for joining me today.